Okay, so in this video, we're going to talking about the chapter 5 of Advanced Accounting 1 by Beams, which is talking about intercompany profit transactions, specifically related to inventories transaction. So basically, actually, you know that this subject, Advanced Accounting, really a kind of sequence subject. You will not understand a specific chapter before you understand comprehensively the previous chapter. So the assumption that must be met in order to finish the chapter 5 is that you have to be completely understand what have been talking in the chapter 1 until 4, especially in chapter 4. In chapter 4 is the first time that you learn about how to journalize the consolidation, okay, how to make an elimination and elimination entries, etc. And now we will continue specifically in chapter 5 when the intercompany profit transaction is related to inventories, and then continue again on the next meeting when the intercompany profit transaction is related to plan asset, and then again continue in chapter 7 when the intercompany profit transaction related to bonds. So this is really like a sequence chapter, yeah? So the basic assumption that must be met to finish the chapter 5, 6, 7, especially 5, 6, 7, yeah, is that you have completely understand the chapter 1 until 4, especially about chapter 4. So actually in the chapter 5, which is talking about this one, we will again meet all of the journal entries that you've already learned in chapter 4. Let me show you and kind of like a reminding for you. So these are the consolidation or elimination journal entries that you've been learned in chapter 4. As you can see here, this is the first journal entries, and this is the second, and this is the third. When we learn about the intercompany profit transaction related to inventories, we will again meet with all of this journal, and then we will have additional journal entries that related specifically about inventory. So basically, we just repeat again the chapter 4 here, but adding the specific journal entries that related to inventory. So that's the story about the chapter 5 actually, which is talking only about the additional journal entry that you must make to finish the consolidation statement. So what is mean actually with the intercompany profit transaction? So it's mean that there is a transaction between a parent and its subsidiary related to the inventories. And these intercompany profit transactions could be two types. The first type is downstream. Downstream is occur when the parent sell the inventory to the subsidiary. Downstream. And then the second type is the opposite. Subsidiary sells the inventory to the parent. So this is what is meant with the intercompany. And then the core issue here is when the parent company want to do a consolidation statement, it must eliminate any transaction related with these things. Okay, so in the consolidated statement, it must not contain any information that show us that the parent and subsidiary has a transaction related to the inventories. So what are the journal entries that the parent company need to eliminate, need to adjust whenever want to doing a consolidation statement and related specifically with the inventory transaction? So it started in this page. Okay, so basically there are three journal entries that we need to make related to the intercompany inventory transaction. The first one is we have to eliminate the sales and cost of goods sold, which is the number is related to the transfer pricing. Okay, what is that? Okay, I will explain it later. And then, so that's the first journal entries. And then what is the second journal entries? The second journal entries that we need to journal is related to elimination of unrealized profit in ending inventory. So that's the second journal entry. Yeah, we have to eliminate the unrealized profit in this current period, and the journal entry is cost of goods sold on the debit side and inventory on the credit side. And then what is the third journal entry? The third journal entry that we need also to make is the recognition of unrealized profit in beginning inventory. So this is kind of like the opposite of the previous journal entries. So in these third journal entries, we have to finally recognize the unrealized profit from the previous period, which is finally will be realized in this current period. And this is the journal entry. Investment in S on the debit side and GOGS on the credit side. Okay, so this is actually the basic journal entries, and the assumption is that the type of transaction of the intercompany inventory transaction is downstream, because later on you will see that when the transaction type is the upstream sales, there is a little bit a difference in the journal entries. So keep in mind that this is the journal entries that the assumption of the intercompany inventory transaction is downstream. Okay, so now we discuss one by one these three journal entries. For the first one, eliminate the sales and cost of goods sales. So what number that we should journalize here on the book? Maybe we can discuss it by the example that was given by Beams here. So as you can see here, as you can read on this case. Okay, so Pop sold merchandise that cost 40 and then sold to Son at the price of 48. And then Son sold all the merchandise to its customer for 60. So this is, of course, the type of intercompany transaction, intercompany inventory transaction downstream. So P sold to S, and then S sold to the ending customer. The original amount of the inventory actually 40, but P sold to S at the price of 48. So P got the markup 8, right? And then S sold to the end customer 60. So S basically has a markup also about 12. Then for the first journal entries, we have to eliminate this reciprocal transaction that we should make the sales disappear on the consolidated statement, that it should not be shown that they actually sell the inventory to S. So that's why the first journal entry is we have to eliminate the sales. Okay, sales, you know, the normal balance is on the credit side, and then because we have to eliminate it, we located it on the debit side. And the same also for the cost of goods sold. The normal balance is on debit side, and then we eliminate it, we located it on credit side. And then what's the number? The number that we should journalize in here is the transfer pricing. So among of these three numbers, which one is the transfer pricing? The transfer pricing is the, like I would say the middle number, 48 here. This is the transfer pricing, okay? Sorry. Nah, this is the transfer pricing. So we have to eliminate this 48 number. So the journal entries, the consolidated journal entries, the first consolidated journal entries should be sales on GODS. Okay, sales on GODS. Okay. This is another example. Yeah, that's why the number is different. So I just want to tell you that the number that we should journalize in here in the first journal entries related to the elimination of sales and GODS, the number that we should enter to that journal entry is the transfer pricing amounts. The middle number, the price that P given to S when P sells the inventory to S. Okay, so let's move on to the second journal entries that we have also eliminate any unrealized profit in ending inventory. So it's mean that we have to eliminate the unrealized profit that occurring when P sold merchandise to S, but not all of this inventory actually will be sold by S. So there is a remaining inventory that stay on the book of the S. So that's why we cannot, from the consolidated point of view, we cannot recognize that profit until the inventory finally sold to the end customer. So the number that illustrated by beams here is actually continuing from the previous story. So the previous story that the transfer pricing is 48 is for the year 2016. And now we continue what happened during 2017. So the type of the intercompany profit transaction is still downstream, right? So as we can read here, P sold as, okay, P sold as, actually the original amount of the inventory is 60 and then sold at the amount of 72. Okay, so we got the clue here that this number is of course the transfer pricing. So you can directly make the first journal entries related to this intercompany profit transaction. That first one, you have to eliminate this number by using the previous journal entry, right? Sales on GODS. Okay, so you can see here, sales on GODS, sales on cost of sales. Okay, and then let's continue what happened there. During 2017, sold all but 12 of this merchandise to its customer for 75. Okay, so the first thing that you need have to do is that you need to compute the unrealized profit that occur in this transaction. So I'll focus on this number. Okay, focus in this number so we can conclude that the markup here is 12. Okay, the markup here is 12, but the 12 in here cannot be realized 100% by P because there is still any inventory that's still unsold by S. So we gotta have to compute the real unrealized profit that occur in this transaction. So now let's just focus only on the amount of the transfer pricing, or I mean from the point of view of the S. Okay, S has an inventory that the amount is 72. Okay, And then actually all of them but 12 is still unsold. So it's mean that we have 12 still unsold here, okay? And then 60 is finally sold. So now let's move on from the point of view of the original amount, from the point of view of P. From the point of view of P here, we gotta also have to compute how much that actually unsold and sold. So as we can compute here, 12 per 72 with 60 per 72, it's mean that this is 1 per 6, right? And then for the sold part is the 5 per 6, right? Can you please also confirm this computation, yeah? So it's mean that we can also apply this proportion between unsold inventory and sold inventory here in the number for the point of view from the P side. So for the unsold inventory, we can compute that the number is 1 per 6 times with 60, right? We got the number that the original number of the unsold inventory is 10. Okay, and then for the sold proportion, which is 5 per 6, okay, times with 60, so it means that the sold inventory is 50, or you just subtract the number between 60 minus 10, we got this number. Okay, so what does it mean? So finally we can compute the unrealized profit that occurring here. The original profit that should be recognized by P if all of the inventory sold is 12, right? But because 1 per 6 of its inventory is still unsold by S to the end customer, so it means that from this number we got also the unrealized and realized part. Just the same, we can use the number 1 per 6 times with 12 here, which is 2. And then for the realized is 5 per 6 times with 12, which is 10. Okay, so it means that we have unrealized profit total is 2. Or you can just looking for the difference between this number 10 and this number 12 minus 10 is also 2. So we got the number of the unrealized profit here that should be eliminated in the second journal entries. The number that we should journal is 2. So that's why the second journal entry, okay, 2000, we have to eliminate the intercompany profit transaction that's still unrealized. And the journal entry is cost of sales to inventory. So this is the second journal entry, yeah. Cost of sales to inventory. So we have to defer. We have to not recognize this unrealized profit because the inventory is still unsold by us to the end customer. So that's also P cannot recognize this number until S finally sold this inventory to the end customer. So this is the second journal entry, cost of sale to inventory, and I hope you understand the logical thing behind how to compute this unrealized profit number. Okay. So let's continue to the third journal entries that we have to recognize any unrealized profit in the beginning inventory. So actually this is continuing the previous journal entries, which is on the previous journal entry, we cannot recognize any unrealized profit in ending inventory. But when finally this unrealized profit when finally this unsold inventory is sold in the next period, we finally gonna have to recognize that unrealized profit. So okay, let's continue the story. So this is what happened during 2018. So during 2018, okay, let's discuss together the problem here. P sold to S, again, still downstream, right? The original amount, the original cost of the inventory is 80. And then P sold this inventory to the S 96. And then, okay, differ with the previous period, which is we gotta have to looking for the proportion, how much that's still unsold and how much that finally sold, 1% and 5%. This is in this problem we got that information in detail. So 75% is sold. So it's mean that, okay, just the same like before, unsold here and sold here. Okay, the sold is 75%, so it's mean that the unsold is 25%. Okay, so let's just compute the number here. Times weight is, this one is gonna have 72 and this one is, okay. So it's mean that we have the same issue like the previous year, that we have to differ, we have to like eliminate any unrealized profit. So we gotta compute the unrealized profit that cannot be recognized in here. So the total of the profit from the point of view of P that get from the S is actually 17 here, 16, yeah, 16. And then also we gotta have to find the proportion of the unrealized and realized. So the unrealized is 16 times weight, 25%, which is 4. And so the remaining is the realized part. Okay, so we got the number that we also have to journalize like the previous journal entry, like the previous case, that we should also make the second journal entry related to the unrealized profit here by using the journal entry same like before, yeah, cost of sales on inventory. So take a look at this number. Okay. Okay, so this is not the third journal entry, yeah. I just want to tell you that this is the same issue. And also don't forget to journalize also the elimination intercompany sales and purchase by journalize the transfer pricing, yeah. This is the transfer pricing we have to eliminate by journalize sales on GOGS. So this is the first and the second journal entry. So the new journal entry that you need to learn in here is actually, look at this statement. Sun also sold the items in the beginning inventory with a transfer price of 12 to its customer for 15. So this is continuing the previous story that actually this number, okay, finally we can recognize this number on the 2018 because it's finally sold to its customer. So when the previous year we cannot realize that in 2017, but now in 2018 we can finally recognize this by journal this entry in the green color. Okay, so the journal entry is that investment in S on cost of sales. So that is the third journal entries. okay, that we finally can recognize any unrealized profit that occurring on the previous year, that finally that inventory is sold to the end customer in this year. So as you can see, when the previous year we debit on the debit side, debit the COGS on the debit side, and then when it's finally recognized, we credit the COGS in here. And then on the debit side is the investment in S, okay? Is the investment in S. So that's the three journal entries, the three unique journal entries that related to intercompany inventory transaction. And what about the remaining journal entries that you also have to journalize? Go back again to the chapter 4. Okay, to the chapter 4, all of this journal you must also journalize. Okay, 1, 2, 3, and any other reciprocal. So please keep in mind that these three journal entries that you've learned in chapter 4, you have also to eliminate this journal entry, and then related to the inventory is these three journal entries. Understand, yeah? So so the next issue is that how to compute, okay, how to compute the investment in S, the income from S, and etc. And please be keep in mind that what we've talking until in this point is that the assumption of the type of the transaction is still downstream. Okay. Okay, so now before you learn about how to compute investment in S, income from S, that related to the inventory intercompany transaction, I need to explain first about the upstream sales. Okay, so the previous discussion that I have explained to you is related when the intercompany profit transaction is inventory is downstream. And then how about the upstream? Okay, the upstream is occurring when the S, okay, sold inventory to P. So that's why it's called upstream. And then what is the difference when the issue here is the upstream? You have to again remember that when go back to the acquisition process, yeah, to the logical of the acquisition process, when P by S, sometimes of course at the great amount, yeah, at the high amount of proportion percentage of ownership. Let's say that P by S about 60%. So it means that S is owned by P 60%, and 60%. I'm sorry, 90%. So how about the remaining, the 10%? The 10%, it means that S also owned by what we call with the non-controlling interest, or let's say that the general terminology for P here is called majority, and then the non-controlling interest here is the minority parties versus the majority parties. Okay, so when we're talking about the intercompany profit transaction related to inventory, it means that S will get any profit when S sell the inventory to the P, right? So let's say that S sold to P, the original amount of the inventory is 50, and then sold to P, let's say at the amount of 60. So it means that S get the profit 10, right? And then when P want to make a consolidated statement, it means that the income that S get here will include this number, right? But because P owned S only 90%, P cannot recognize this profit 100%. Understand? Because the 10% of it must be recognized by the NCE. That is the NCE part. So in the upstream sales here, you gotta be careful when want to journalize the profit that coming from the upstream sales, is that please be careful with the ownership percentage of P to the S. Like in this case, when the profit is 10, so it's mean that P only worth 90% of it, which is 9, and then the 10% of it goes to belong to NJE, non-controlling interest. So that's why what I mean in here. Okay, wait, this one. I am sorry, too far. Okay. Please be careful if the transaction is the upstream, because P cannot, because P is not on the P 100%, so the recognition of the profit also cannot be 100%. So there is an additional journal entry here, not a new journal entry, but more like we have to adding one row here when we're talking about any profit that's still unrealized. Yeah, remember? I'm sorry, when we're talking about the profit that finally will be realized, okay? Because P not on as 100%, so it's mean that the portion that goes to the P, only the portion that mirroring its percentage of ownership. So we gotta have additional row here, and we call it with NJE, because the 10% is belonging to the NJE, and then the 90% is belonging to the parent. So this is the only difference, yeah, between upstream and downstream sales. But please be careful again. Please be careful again. Let's say P on S. Where is it? Nah, this one. Let's say P on S 100%. Let's say P on S 100%. Okay. So if the transaction is the upstream sales, but P on as 100%, the journal entries, the logical of all the journal entries is just the same with the downstream, okay? Because P on S 100%, so it's mean that when S generate profit, P can realize those 100%, those whole amount that belonging to the P. Okay, so when the upstream sales, please be careful about the ownership percentage.